50 or nothing nation. It's this time again. Welcome to January 2026 video update. I have some really exciting news to share with the community. But before we do, as always, nothing that I share in this video is financial advice. Investing in stocks always bears a risk. You could lose money and you could win money. So just be aware of that. Here is the exciting news. I'm going to launch a website in which all of the 50 or Nothing community members will have access to. And in that website, you will be able to value any company. And here's the good news. You don't need to be any financial expert to be able to value that company. That I'll take care of. So all of the cash flow models will be in the background. What you will be needed to do is to add your assumptions. And by adding your assumptions, you will get a value. Um, and of course, I'm going to give some training videos for you to be able to just understand the basics and what is important before you start valuing a company. All of that will also be given. Another cool feature that you will have also in the website where you value companies is you're going to have the break-even revenue technique. And here it is the formula for how to calculate the value of an equity or a stock price. But here instead, I ask a different question, not what the value of a company is, rather what the revenue should be given the current market valuation. So here you look at the stock price, I add it to the formula, I add net margin, I add return on equity, all taken from the financial statements. And then I solve for revenue. And that will give you what the market is expecting in revenues, if it's too high or if it's too low. And you will be the judge of that to see if, hey, the value of the stock is low, but also what is it saying about revenues? Do you expect 50% in revenue increase in 5 years? Maybe it's too high, meaning the stock price could also be too high. So that is a really good technique to use, and I'm going to show you exactly what I mean in 2 minutes. Moving on, Sonara Medtech. This is a stock that we're going to use now to value Sonara Medtech in the technique that I showed you, or I will be showing you, and that you will have in the website. But you will be able to value any company you wish. But about Sonara Medtech, the stock has declined over the year, and they decommissioned their Tissue Healthcare Plus. That was a bad news. And on top of that, they lowered their revenue guidance over the year. And of course, that made the stock price plunge from $30 to now $20. And you know, my average cost is $30 for Sonara Medtech. And now, as I told you, and I wrote it in the Patreon, I had a friend who had an interview with Sonara Medtech CEO and CFO. And they have come up with new guidance. So for 2026, they're expecting to grow around 13 to 17%. This is really good because now that is disproving the market punishing them too much, saying that they're not a growth company anymore. But they are if they're expecting 13 to 17 revenue growth during 2026. And for 2025, they'll close their books growing by around 19%. So what I'm hearing from the management is that they want to double the revenue. They currently have $100 million in revenue, and they want to double that to 200 million within the 2, 3, 4 years. There's a company called Visent Group. It's a purchasing organization representing thousands of hospitals over in the US. And Visent has now chosen Sonara Medtech's products over the competitors, and that's a seal of approval. And it shows you that Sonara Medtech's BioSurge solution is far superior than the competitors. That's also something that we're going to help Sonara Medtech grow their revenues by 13 to 17%. That what management is targeting. Let's value Sonara Medtech. What I do is I go to a website called Cofin, Python is where I get my data from. It's my data source. And I've built this Excel sheet. So you go here. What I do is I paste all of the data that I think is important for me to analyze. Then I have built a macro and I'll let the macro run. And what this macro does is that it just converts all of the numbers into a format which my valuation tool understands. I go in here. This gives you the beta. The beta is needed for you to have to calculate the required rate of return, or WACC. But again, this is nothing that you need to bear in mind. All my models will do that for you. So here you just type in the company. So let's use Scenariometric. And Scenariometric is now being run a regression towards the American stock so you can get the beta. What you do here then is just you press refresh. And now you get the data for Scenariometric. And here we can see, for example, that the revenue has surged year over year. The bluish line is the gross margin. And you can see here it's a hefty 90% gross margin, which is really, really high. Now let me zoom in a bit. And then also you see the profitability. It has been negative, but now it's turning positive. The growth, the annual compounded growth rate has been 38% a year, which is really good. And look here, the free cash flow is giving 11.87%. So it's trading at a free cash flow yield of around 12%, meaning you get your money back faster than 7 years. And what's driving this is this diagram to the right. This is the free cash flow. So you're going to have all of this to look at. Here is the free cash flow, and below is the reinvestments, and reinvestments in capital expenditures, working capital, net of depreciation. And you can see here that the cash flow has increased because reinvestments are negative. So the free cash flow is, of course, inflated. Normally, they should have positive reinvestments. They can't keep on having negative reinvestments. Moving on to the valuation. Now you can see here that in the sheet, the models have identified Scenariometric as a high growth company. And this is important for you because if the company has declining revenues here, if they're declining, then the model will tell you, hey, be aware it's a declining company. So you don't go ahead and put too high growth rate and then you're going to overvalue the company. So that is important. This is a high growth company. Then you're going to say, it's going to ask you what return on capital do you need for during high growth. It tells you my input, so you put your input, or it tells you the average return. I'm going to use my input. The reason is if you pick the average for Scenariometric, you're going to get a skewed return on invested capital. The reason is because it's negative, is because Scenariometric is losing money. So if you put a negative amount here, it will going to give you skewed value. So I'm going to instead look at the industry of where Sonara operates, and you can see the return on invested capital for that industry at 11.7%. But given that the gross margin for Scenariometric is 90%, much higher than the industry average, I'm gonna give them a much higher return on invested capital. I'm gonna give them 15%. Then I was gonna ask you, what is the return on invested capital when the company matures, year 10? Here you can't have like 15%. Let's give them 13% when they mature. Here is the weighted average cost of capital. This is the required rate of return. And this is not this the cool thing here is it calculates it by itself. It picks the beta from the industry, it picks the depth from the industry, and it calculates the weighted average cost of capital. Then it tells you what weighted average cost of capital do you want to use in year 10 when the company matures. I'm going to pick 9% because it's going to get lower once the company grows much bigger. The risk will get lower as well. Here it asks you what growth rate do you want to use for Scenariometric during the growth years, and I'm going to pick, let's pick 9%. Remember, management is targeting 12 to 13% or even higher, but I'm going to pick 9%. It asks you, how long do you think the high growth duration will last for this company? Now, if you would have, say, Hexpool, which is a mature company, I would pick 0 because it's already mature and they should only be growing by the risk-free rate. But given Sonara is a young growth company, I'm gonna put 10 years here, and that they will be able to grow by 9%. Stable growth rate. Now it asks you, what do you believe the company will be growing once the company matures in year 10? I'm going to pick 3.7%. And the reason I'm picking 3.7% is that we're talking US dollars here and we're talking about Sonara. So we then need to focus on the government bond yield of that company, of that country, which is United States. And the government bond yield in United States sits around 4.2, 4.3%. But then if you net out the default risk, you're going to get the net growth, which is 3.7%. And remember, you can't grow much faster than the economy in perpetuity because there will come to a certain point once the company matures and only grows by the inflation rate or the risk-free rate. So it's important to not put this much higher than the risk-free rate. And again, I'm gonna give you all of the introductions and videos, tutorials to show you how to value. Marginal tax rate, the global marginal tax rate and the American is 25%. Here it tells you what future EBIT margin do you want to put to the company. Now look here, the EBIT margin of the industry pre-tax is 6.3%, really low. And the gross margin for that industry is 32%. But remember, Sonara gross margin is around 90%. So you could say it's a star within that industry. And that's why I believe their EBIT margin will be 25% and not the abysmal 6.3%. Future net margin, it asks you that. And here again, the net margin for that industry is 5.5%. But I'm going to put much higher because Sonara deserves that with a much higher gross margin. So what should I put here? Let's see, net margin 5.5. And you have the pre-tax operating margin of 6.3. The difference between those two, because net margin is after you pay your taxes, right? It's almost 1%. Let's put future net margin 15%. So we have a 10% difference between those two because they're going to pay taxes and they're going to pay financial expenses to service their debt. Future return on equity, 21% for the industry. Let's see here, Sonara. Their average is minus 71%. And again, you can't use that because they are a growth company and have been they're having losses and they have just turned profitable this year or the previous year. Let's put higher than that because they have so high gross margin. Let's put 25%. Now we're done. So let's see what's happening here. Remember I told you about the technique of asking a different question? Or what should the revenue be given the current stock price? And this is what it tells you. So it tells you that within this year, 2025, and Sonara current revenue is $100 million, right? It tells you that given the current price of Sonara, which is trading around $22 today, the market is expecting a 16% drop in revenues, which is really conservative, right? And if you look in future, it tells you 10 years, because I picked 10 years here, it will look 10 years ahead. It tells you for 2035, the market is expecting now that the company will grow only by 5.6% every year until year 10. And it will have then a revenue of $176 million. So there are conservative revenue growth estimates by the market, which is really good. And that's why it tells you, the program tells you this is undemanding, this is conservative, you know. So, you know, the likelihood of the company achieving these goals are really high. But if, in contrast, if this was like, given the current market value, the market is expecting 50% growth during this year, or 50% every year in 10 years, then I would be really, really pushing it. And then I would probably not value that stock. So this gives you a quick check to see if your company deserves, or if it's undervalued or overvalued. Coming in here, you have the output now. 100 million current revenues. If you use your 9% gross, it's going to give you $241 million in year 2035. And the current EBIT margin of the company is 1.5%. I'm giving it a 25% in 2035. And now here it values the company. Here you could add your manual adjustments. This was for Coupang. They're facing a fine of 1 billion, but now I'm using Sonarmetics, so they don't have risk of any fines. I'm going to put that as 0. Now you see that it gives me a value of $34. The company, the current stock price is $22. It equates to 55% return, given these assumptions, right? Now, if you would use instead, if I look here, I would say my weighted average cost of capital is too high in year 10. I'm going to use 8% because it's an American company. They don't have any operations in emerging markets, and it's a quite safe company. You can see here, $44. And this is here, when I wrote about Sonarametic in Patreon, I arrived to this value, and it's almost a double. And before you jump in and buy a lot of Sonarametic shares, just beware that the company has a lot of debt, and they need now to demonstrate that they can turn their profitability and increase that profitability as much as they can this year. And I don't think they would have a problem doing that, given their gross margin is 92%. They have now been prioritizing growth, but I'm thinking that they should now also start prioritizing profitability and refinance their expensive debt that they have. So this is it. This gives you the model, so you don't need to be an expert. All of the formulas is in the background working for you. Please let me know what you think of that. I'm gonna paste that in the chat for Patreon, in the community chat, and you could tell me about your thoughts. Like, are you interested? Would this be cool to have in a website where you could just value any company you wish to value? You don't need to wait for me or to sit around and buy exactly the companies I want to buy, because maybe I'm skewed towards a specific branch or etc. So please let me know what you think. You could paste it in the comment chat in Patreon or in the community chat. Thank you for listening.